Hey, welcome back. I'm Rick Harrison, and in this week's Southwest Florida housing market update, I'm going to show you the latest data, inventory levels, and trends in the housing market, as well as the major economic news that will affect your decisions going forward. That's all coming up right here. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest market news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome, and if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. All right, so over the last week, we have seen some new trends start to emerge in the real estate market, and I'm going to be going over those stories as well as our local market data between north and south parts of Southwest Florida. So let's dive right into the local market stats. And we'll start out with Cape Coral to Naples. I'm actually going to remove myself completely from this. So over the last 7 days, we had new listings go from 848 last week to 811 this week. That's down 4%. Despite the new listings being down, that's because of record highs over the last 3 weeks for new listings. Although that is down, new inventory has gone up this week as well. Solds went from 938 to 680 this week. That's down 28%, which is a huge decrease, but that is also an indication of what has already happened in the past 30 to 45 days. We knew that pending sales were down over the last 2 months or so, which now we're starting to see reflected in the sold data. Pendings again went from 741 down to 723. Not a huge decrease, but down 3%. Again, that trend of going down despite rates actually being up. Another new record set for price decreases, 872 price decreases over the last 7 days. That is up a huge amount. So we'll have to see if that will continue. Looking at the inventory breakdown, single families went from 4511 over from last week to 4689 this week. That's up 178. Condos went from 2031 to 2088. That's up 57. So we had a net gain of from 186 last week to 235 this week. So the new listings are up again, more so than last week. So that's good news for buyers and inventory. However, we still are struggling with the interest rates. Multifamilies went from 169 up to 184. This is the highest number of multifamily listings we've seen on the market in over 2.5 years. Foreclosures went from 44 up to 50 this week. That's up 6. So that is actually a new uptick. We've usually been seeing it in the 30s to really the high 30s, but now we're starting to get into the 50s. So we'll have to see if this trend continues and see if the actual foreclosure rate starts to tick up even more so now that we're getting past the moratorium, and that's all starting to come to full fruition. Now we're going to take a look at the northern half of Southwest Florida. So Punta Gorda all the way up to Tampa. New listings last week were 2145. We went down to 2056 this week. So that's only down 4%. Keep in mind these numbers are really large because these counties are actually very large as well. The big news here would be the price decreases also up 30% week over week from 1833 last week. Price decreases to 2378 this week. That's up 30%. So that's a huge amount. Solds went from 2354 to 1553. That's down 34%. Again, 30 to 45 day lag. So this is a lagging indicator. The leading indicator is 1969 to 1957. That's down 1% for pendings week over week. So again, this is following the same trends as the southern part. However, this is, we're not seeing quite as many homes going, I guess we're seeing a pretty steady amount of homes going off market and compared to the actual new listings. However, some new data just to give you an idea. The chart on the left is the actual trends over the last 10 years in the market. The green line at the top indicates the number of new listings coming on the market, and the blue line indicates the number of sales, total sales. So you can see that the blue line, the total number of sales, has steadily been increasing from Punta Gorda to Tampa. However, new listings, as you can see from 2012 up to about 2017, they were increasing at a pretty gradual and consistent rate. And then we started to level off and actually head back down a little bit for new listings into right around 2021. And then right here from January 2022, we have a huge spike. You can see that the new inventory coming on the market has actually increased greatly. So if we're comparing the right-hand chart, which is the last, well, really since January, the last 2.5 years, January of 2019 to today's date, you can see the same kind of thing happening. Number of sales in blue have steadily increased to about, halfway through 2021. And then they started to head back down, which is kind of consistent. But then when we hit in 2022, you can see the listings take off. So the number of new listings go up, and that's where that circle is. And the number of sales is headed back down. So we're hitting new or lower highs on the way down for this second chart. Going into the interest rates, week over week, we went from 5.339 interest rate last week to 5.699. That's according to NerdWallet. According to Bankrate, we went from 5.61% to 5.75%. So that is trending back up a little bit. And despite the actual interest rates going back down, we did not see an increase in mortgages coming back on the market. So now we're going to get right into the actual stories for the day. So over the last week, we have seen some new trends start to emerge, not only in the economy, but the real estate market as well. I'm going to be going over those stories today. As you can see from the headline highlights, where can you rent in Florida for $1,500? Home sales getting canceled, mortgage applications down again, despite rates actually decreasing. Costco CEO warning most consumers are already in a recession. Amazon's also going to be canceling or has already canceled over 10 million square feet of warehouse space. And we're also expected to see elevated CPI data coming in this month for June. We're going to start out with where can you rent in Florida for $1,500 a month? So just going through this is right from Florida Realtors. In June, Florida median rent hit $1,726 per month. That's up from $1,408. So as you can imagine, adding an additional $300 per month when wages haven't increased all that much. If you really look at the real increase in wages, we have 8% inflation, and the average wage went up 5%. So you actually lost 3% on your money, on your earnings. So while that is happening, we also have rent increasing, which does take into account inflation. But from 1726 up from 1408, that's not a 5% increase. And in most places in Florida, we've been seeing upwards of 30%, high 20s to 30% increases in rent year over year. So that's definitely not staying up with it. So while a unit for $1,500 is still possible, it really does depend on size, quality, and location. The median rent hit that $1,726. USA Today network just settled on $1,500 as a benchmark after taking into account the median household income, which is about $57,000, $58,000 in our area, and is $17,000 or $1,440 a month. So the team rounded that up to $1,500 to see what the experts recommend in terms of spending. If we're looking at Sarasota County, for example, the median rent hit $1,955. That's a 24.7% increase over the same month a year before, and a 2% increase from May. But keep in mind what you're getting for this. This is on the north side of Sarasota's Bobby Jones Golf Club. It's a 639 square foot, one bedroom for $1,450 a month. So you're not getting very much for, spending a considerable amount on rent. Keep in mind, the location. You're getting a better location, obviously, with a golf club. But the size for what you're paying. If somebody calls in and their budget is under $2,000, frankly, Jennifer Putnam, branch manager of Coldwell Banker Realty in Sarasota, said we tell them to go to an Airbnb and go on the internet, because for most realtors right now in a position like this, especially in the higher areas, we don't really have anywhere that we can send you. Even when we go through the entire MLS, despite there being a ton of inventory on the market for rentals, a lot of homeowners and landlords are expecting to get these huge rent increases because they've been seeing that rent is going up, and we're still hearing about the inventory being a problem. So Florida newcomers behind the raging demand, as I've been talking about for months now, probably actually over a year now. The newcomers during the first 3 months of the year, nearly 10% of people searching for rental properties in Palm Beach, Broward, and Miami-Dade were from New York. So they're used to higher leasing costs to make that, which makes South Florida and Southwest Florida prices seem like bargain or basement. You know. The next story is the deal is off. This is from Redfin News. Home sales are getting canceled at the highest rate since the start of the pandemic. This is a newer trend that we're starting to see in the market coming from a lot of the builders. The builders have started to, I've been talking about this for the last few weeks, but the builders have been starting to introduce pretty incredible incentives for buyers to work with them. They're also offering buy down programs where they're going to, some of them will be able to buy down your interest rates to a certain percentage. I've seen it as low as 2.75% the first year. They're also offering the agents bonuses, not only the full 3%, which a lot of them got rid of during the pandemic, for a buyer's agent to bring in a client, but they brought that down to 1%. Some of them were offering actually buyers a bonus to not bring in or to not use an agent outside of their building. But despite that, now a lot of these builders are begging for the real estate agents to help them bring clients in. So they're offering bonuses on top of the full commission, and on top of some of their other incentive programs that they offer real estate agents and buyers. So we're seeing this trend start to shift pretty rapidly. But in this case, Redfin, nationwide, roughly 60,000 home purchase agreements fell through in June, equal to 14.9% of homes that went under contract that month. That's the highest percentage on record, with the exception of March and April in 2020, which, as we all know, that's when the pandemic really hit. We locked down, and that's when a lot of people just canceled it. And you can see the huge spike from this chart, 17.6% in March, which is when we locked down. And you can imagine why there were so many cancellations. People had no idea what was going to be happening. So you see all those cancellations spike. But again, now look at where we are now. 14.9%. This is the highest since back in April of 2020. So this is a huge clip. And if this continues, we're probably going to see a huge slowdown in building, which is not great for inventory if something doesn't happen in the economy where, unfortunately, people end up, having to move out of their houses. If that doesn't change, then we could see this, this housing situation prolonged. But it will all come down, I think, to the recession, to layoffs, things that we've been talking about for a long time, consumer credit card debt. So if any of those things, or a black swan event of some kind have an effect on the housing market, it could very well bring inventory. But as of right now, it looks like the housing market or the builders are actually starting to slow a bit. Mortgage applications, according to the Mortgage Bankers Association, there was another decrease this week, despite actually the interest rates over last week decreasing. If you remember one of the headlines from last week, it was the largest interest rate decrease in, I forgot how many, since 2008, 2007. We went from almost 6% down to 5.3%, which is a huge jump in a week. But, compared to where we were a couple months ago at 3.5%, 5.3% didn't really look all that appealing. So the refinance index also decreased 8% from the previous week and was 78% lower from the same week a year ago. So 78% down from 1 year ago is a huge jump as well. So you can see that refinances are way down, and mortgage applications continue falling for quite a few weeks now, actually a couple months. So this is all really showing us that the mortgage industry itself is really slowing down. And that's where we're seeing a huge amount of layoffs. I think we're going to see a lot more still. I also think there's going to be a huge exodus from the real estate market as far as we're heading into kind of a recession or a winter, as you might call it, in real estate. And I think a lot of the real estate agents who got into the market over the last couple of years when it was really good are going to be leaving. They just won't be able to sustain what they've been living on. FHA, just to give you a breakdown of what's going on inside of the applications, FHA was unchanged. So we're still seeing a pretty close, similar share of total applicants using the FHA, which has been increasing over the last several weeks. The VA also really didn't change too much, went from 11.1 to 11.2. And then the USDA also remained unchanged. So really not much of a change as far as the ratios of FHA, VA, and USDAs being taken out. It's the amount of total applications that is down quite considerably. Costco CEO warns a lot of consumers are in a recession right now. The White House and Federal Reserve offer their perspective. We've been hearing about this in the news. Everything's transitory. The consumer is strong. Economy is doing great. The only thing that's crashing is the stock market and the bonds. So I'm not sure how those things can really be said, but they continue to say it anyways. Fails to show the entire story. The consumer isn't doing bad, but a lot of people right now, they're in a recession because they're just trying to survive by just buying gas and making house and rent payments. So despite being a little confusing as to what he's saying there, they're not doing bad, but they're also struggling. It depends on who we're looking at, right? So wealthier households still have discretionary income to buy goods, which means the lower tier of consumers is perhaps tapped out. And we've been talking about that quite a bit over the last couple of months, where credit card debt is at its highest it's ever been, and it's been increasing at an exponential rate month over month. We'll have to see where the numbers come out again, but over the last 3 months, they've gained over, $50 billion in just two months. So consumers are getting more cautious, not necessarily a sign that consumption is about to roll over, but the cracks are appearing. I think it's going to roll over, and I think that is going to start showing even more cracks, especially with the backup of inventory that all these retail stores are now having. And really, what I saw, or at least my perspective on what happened with the pandemic, is that shutting down, people got a lot of money that they didn't really, it was excess money they didn't really need at the time. And instead of saving it or stocking it away, they went out and spent it on luxury things that they didn't really need, or they put into the stock market and speculated on stocks or crypto. So we're seeing a lot of those kind of bubbles that I think really built up pop. But again, this is going to come back to the consumer. Where are we at? We've already drained through most of our savings. We're back down to new lows with that. We're at new highs with credit card debt. Those are maxed out. So if this kind of trend continues as it has, and you can see right here, the consumer sentiment is way down, and it's been falling as the Fed is going to continue hiking the rates to try to get back up to the 2-year bond. Another story that was, this is a little while ago, this is back in May, but I think it really didn't get enough coverage. Amazon, who besides Facebook and Google, Amazon would be the next biggest place that you're going to see retail stats and is going to know what's going on in the economy. And they're actually selling off 10 million square feet of warehouse space so they're seeing a huge decrease in demand for goods. And they know that they don't need quite as much as they had been planning for space for products and for storage. So set to close more than 10 million square feet of warehouse space. The online giant says now the pandemic online spike is over. It no longer needs so much space. So exactly what I was saying, we got a spike from that demand. It's not a natural demand. It's an artificially inflated demand. Space and leave more empty by terminating its agreements with landlords, which that's going to put landlords into a bind. New Jersey, Atlanta, Southern California, New York are all set to go. And 2 of the insiders suggested the surplus of space may be significantly greater than 10 million square feet, with one claiming it could be triple that. So we'll have to see if anything else comes out about the amount of space, but 10 million square feet is actually pretty much, it's about, if you took the 12 largest fulfillment facilities of Amazon right now, or about 5% of the square footage added during the pandemic, that would cover those 12 facilities. Also, this actually just came out as of about an hour or 2 before shooting this. So this evening, the White House foresees June inflation reading as highly elevated. So as we've been seeing, supposedly the economy is strong, the consumer is strong because we keep spending, according to all this new data that comes out. So the Fed is likely to continue raising the 75 basis points again this time. And with that, I think we're in what's basically a vicious cycle of sorts, where we're spending more because we have to meet the prices. But that is also reflected in what we're spending. So it looks like we're still strong. So now they have to continue hiking the rates. So they expect the June consumer price index figures to be highly elevated, as we obviously grappled with substantial increases in the cost of gasoline and food. But the reading was already out of date because of falling energy prices. And this is where it bugs me a little bit, because you can't, downplay the bad news and then always upplay the good news, because it's really not being, subjective about the whole data that you're projecting. But economists surveyed Bloomberg expect the report to show rose 8.8% in June. So that would be up again, which last reading we got was up unexpectedly from 8.3 to 8.6. Now we're going from 8.6 to 8.8 this time, which would be a new 40-year high. But they continue saying that it's out of date because we've already seen the energy prices fall, and gasoline's still down right now, which is also artificial because we released our reserves. But we will see how commodities play out, and that's pretty much it. So we'll have to keep on top of that. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.